amount so long as it does not exceed 12% of the Federal Reserve's total operating expenses. For the first 5 years of the existence of CFPB, of course, there was a relaxation there with respect to that 12% cap that allowed $200 million annually to be spent beyond that number so long as it was reported, so long as the reported excess was sent to the President and congressional appropriators. Chair Powell, during your chairmanship, has the Fed ever rejected a CFPB budget request?
I do not believe so.
And could you tell us what policies and procedures are in place at the Fed to ensure that there is no waste, fraud, or abuse, or that these limits are not otherwise exceeded?
So we have no role in engaging with that. It's really what we share a common inspector general who does work on those issues, but we don't in any way, we don't have any governance of any kind over the CFPB. We're just a source to them.
Thank you. I appreciate that insight. In closing, Chair Powell, yesterday Senator Warren asked you what you would say to the 2 million people who may lose their jobs if the Fed keeps raising interest rates. Frankly, Senator Warren should be asking herself the same question when she voted and advocated for the Democrats' reckless spending packages that caused this inflation that we are seeing today and is the reason the Fed has had to raise interest rates, in my view. Frankly, I would call on Senator Warren, the President, and the Democratic Party, for that matter, to apologize to the American people for causing this kitchen table crisis across the country. With that, Chairman, I yield back.
Now recognize the gentlewoman from Massachusetts, Ms. Presley, for 5 minutes.
Thank you, Chairman Powell, for joining us today and for your testimony. I'm going to focus my comments and my questions on the high costs that families in my district are seeing because of your interest rate hikes. Now, while the Fed has acknowledged that higher interest rates are not the primary driver for the slowdown in price increases, you continue to raise interest rates, risking not only millions of jobs, but also a recession. Based on projections from the Fed, approximately 2 million people will lose their jobs. So that's 2 million families who will struggle to put food on the table, keep a roof over their heads, and to make ends meet. But the economic hardship does not end there. Mr. Chair, I would like to request unanimous consent to submit a recent paper by the Federal Reserve Bank of Cleveland titled Post-COVID Inflation Dynamics into the record.
Without objection.
Chairman Powell, are you familiar with this publication, yes or no?
No, I'm not.
Okay. Well, let me give you some context. In this paper, the Fed's own economists predict that reaching the 2% inflation goal that you have set will be impossible without causing a recession and spiking the unemployment rate to 7.4%, which translates to millions of working people losing their jobs. Now, Chairman Powell, many economists agree with me when I say that engineering a recession to bring inflation under control is not the right strategy, especially at a time when we are seeing inflation cool in real time, independent of your rate hikes. So on behalf of the people of this country, to prevent a recession, yes or no, Chairman Powell, will you pause future interest rate hikes?
We're not seeking to have a recession, and we don't think we need to have a recession to get price stability back.
Will you pause interest rate hikes, yes or no?
I don't do yes or no on will I pause interest rate hikes. Yeah, that's a serious question, and I can't tell you because I don't know all the facts. That's not a possible.
Reclaiming my time, and in fact, it is a very serious question because it has a very serious implications. The people who will bear the brunt of an economic recession are our most vulnerable. We know from past experiences that recessions have catastrophic and deeply inequitable consequences. In fact, while some will catch a cold, others will catch pneumonia. But you know that. An economic cold or pneumonia. In fact, in your opening statement, you said, "We will stay the course until the job is done." To conclude, we understand that our actions affect communities, families, and businesses across the country. Could you elaborate, what is this effect to communities, families, and businesses? these interest rate hikes?
Well, right now we're trying to bring down inflation on behalf of all those families. I think high inflation is hurting particularly working families all around the country very badly. And as you know, if you're on a very limited budget and you don't have a lot of excess earnings, when prices start going up, you're in trouble right away. People, middle and upper middle class people have more resources. So we think it's absolutely critical for the working people of this country that we get inflation back under control. And also, while we're at it, we have a dual mandate.
Apologies, Mr. Chair, I'm just reclaiming my time here. Here's the thing. The most devastating impacts will be to our most vulnerable. Veterans to our most vulnerable. Veterans, the elderly, low-income workers, black and brown workers, those who have often ignored and been neglected in the name of what you refer to as appropriate monetary policy. And yet, you assert that you will stay the course. It's unconscionable, and our most vulnerable workers and families cannot afford to wait for you to realize the harm that you were doing. In my opinion, this sounds more like the assertions of a greedy corporation than someone who has a public mission on behalf of the people of this country. One more question with my remaining time here. Chairman Powell, another consequence of your interest rate hikes has been the increase of the average 30-year fixed mortgage rate to 6.6%, double of what it was 2 years ago. Do you see this widening inequity in the housing market as a problem? And what steps will you take to make housing more affordable? This is putting home ownership further and further out of reach for my constituents, new parents, millennials, people of color, contributing to inequities and the racial wealth gap. So what are your thoughts on that?
Well, our policies do
Gentlemen,
affect.
gentlelady's time has expired. Chairs can submit for the record or answer.
I'll briefly say that if I can, that our interest rate policies affect interest-sensitive spending very directly. When we cut rates, they help housing. When we raise rates, you see the effect on housing. So
Thank you.
The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us today. We currently have $32 trillion in debt. Our debt-to-GDP ratio is 120%, the highest it's ever been. And yes, we have a debt ceiling fight brewing for this summer. I would argue it's an opportunity to get our fiscal house in order. But sadly, there's no meaningful bipartisan effort to responsibly address our debt. Both sides have even preemptively started political attacks, alleging either side wants to cut Social Security and health care. But politics and talking points will not fix our problem. Our debt is the greatest national security threat. Social Security will be insolvent in 2033, and our healthcare system is fundamentally broken. We spend twice as much as the average country per person, and our obesity rate is 3 times the average. I want to be clear, though, I'm not advocating cuts to Social Security, but my Social Security will have to be different than my father's, and we must change the incentive structures of our healthcare system. Briefly, let's go over some history. Social Security was created in 1937. The retirement age then was 65, and average life expectancy was 60. Easy to see how that math works. In 1960, Congress raised the retirement age to 67. It has not been increased since then. That year, life expectancy was 69. That math still works due to a growing population, but it's getting narrower. I will throw in another few statistics for that year, 1960. 14% of Americans were obese, and our debt-to-GDP ratio was 53%. Let's fast forward to this year. Our retirement age is still 67, but our life expectancy is 77. That math clearly does not work, nor is the program functioning in the purpose for which it was designed. And shockingly, our obesity rate is 37%, and we spend $13,000 per person on health care compared to the global average of $6,000 per person and 13% obesity rate. Clearly, our healthcare system is failing. Our system focuses on managing sickness where we should be facilitating health and wellness. We will only meaningfully be able to address the debt ceiling by focusing on the biggest drivers of our debt. Responsible policymakers should be focused on saving Social Security by reforming it and transforming our healthcare system to facilitate a healthy citizenry capable of working and being contributing members of society. The American people deserve more than the political nonsense. 5 years ago, the #1 issue I ran on was debt. It has been and continues to be our greatest national security risk. I hate to say it, but the last 4 years has gotten way worse. Congress has spent $7 trillion, of which $5 trillion was done mostly on party lines. The Democrat majority has not only spent money we don't have over the last 4 years, but their fiscal policy has caused out-of-control inflation, which caused you to raise interest rates. Last year, I asked you if you ever took into consideration the impact of interest rate increases on the cost of our debt service. You appropriately and adamantly said no. Our debt service cost the next 10 years will be over $10 trillion. I'm going to point out two things. Number one, that is more than all of our debt service since 1940 combined, the last 80 years. And while you did not take interest rate increases impact on our debt service into your decision-making, the best estimate is that those rate increases will increase our debt service cost by $2 trillion in the next 10 years. So basically, the $7 trillion that that the Democrats spent in the last 4 years is going to cost us an additional $2 trillion. And that's not factoring in future rate increases as you continue to appropriately try to get inflation under control. As you can tell, this is a huge problem. The $7 trillion in unnecessary spending in the last 4 years has caused inflation. Some of my colleagues across the aisle disagree with that causal relationship. Clinton's Treasury Secretary and Obama's Director of National Economic Council, Larry Summers, wrote an op-ed before they spent the money and said it was going to cause inflation. And he has gone on the I was right tour for the last couple years. We need responsible policymakers to address our debt. Let's talk about what's not serious, and that's minting a $1 trillion coin. Many of my colleagues across the aisle have advocated for this. Luckily, both President Biden and Secretary Yellen have said that this is not a serious proposal, and they have no plans of considering it. Unfortunately, the Biden administration has a bit of a history of doing a 180 when the political winds blow. Most recently, he said he would veto the D.C. crime bill, and now he's adamantly supporting it and plans to sign it. So, Chair Powell, my only question of you is if Biden and Yellen send you a $1 trillion coin, will you accept it?
What I will say to that is that this only winds up one way, and that is with Congress raising the debt ceiling.
So you will not accept a $1 trillion coin and treat it as $1 trillion if it's sent to you?
I'll add there are no rabbits to be pulled out of hats here. This only ends with Congress.
I know you don't like yes or no's, but if you are sent a $1 trillion coin and asked to treat it as $1 trillion, will you treat it as $1 trillion?
That would be a rabbit coming out of a hat.
I'll take that as a no. Thank you. Mr. Chairman, I yield back.
Now recognize the gentlewoman from Michigan, Ms. Tlaib, for 5 minutes.
Thank you so much, Mr. Chairman. Thank you, Chair Powell, for being here. You have a lot of projections, economic projections, various data, various reports that are coming out. How much, and you've studied inflation, right? I mean, obviously, it's your #1 priority right now. How much is inflation impacted by these three things? Corporate profiteering, egregious executive pay, and the use of stock buybacks.
So I don't have numbers, but I would say in the case of executive pay and in the case of share repurchases, I can't think of how it would affect inflation. In the case of executive pay, that would be very small in terms of the broader economy. In terms of profits, though, the way I think about that is profits are high. The places where profits are really high is places where there are shortages and supply chain issues. And as those things get better, as they are, you're going to see inflation come down and even prices come down, and you'll see corporate margins come down there. And that'll be part of how inflation comes down.
So does that corporate profiteering does impact inflation? You don't have any stats of percentage-wise how much of it? Yeah. Because you seem, I really paid attention to your testimony in the Senate hearing yesterday, and there was a lot of conversation about, my neighbors and residents' wages and so forth. They're finally starting to see a little bit more closer to possibly getting fair wages. It's not even far enough, but I don't know if the Feds is paying closer attention to monopolies, corporate profiteering, and executive egregious pay. All of it, even the stock buybacks, you're saying all of that aside, you're focused more on wages and increasing the interest rate than on those other
Our focus is really on price stability, not so much wages. Wages play into that because they're an important cost for business, but they're not. We're not trying to achieve a particular level of wages. We're trying to achieve 2% inflation.
Yeah, and I think it's really important. Chairman, what we saw during the pandemic is, you know, the wealthy and the corporations continued to profit in large scale and still do buybacks and still do executive, really egregious executive pay and benefits and so forth for those at the top. And then, you know, of course, the communities and such were impacted by it. But what I hear consistently is folks thinking that's the reason. All of a sudden wages are skyrocketing and all this. But all I see is continuation, again, of those that are already getting a huge benefit, you know, the folks at the top, the executives and so forth. You know, my friend Glenn taught me this today, that the feds are actually sitting on, you know, something in Dodd-Frank, Section 956. You all are sitting on it for the last 12 years on guidance regarding executive compensation and the high risks of it. Like around, you know, there was some sort of proposal done, not implemented. Again, it's been 12 years. Why is that something that you're not concerned about regarding inflation?
Well,
like you guys are sitting, one, you're sitting on it, right? Why?
Well,
It's been 12 years. And then two, why is that you're saying that's not big deal? That's not going to impact the cost of products and so forth for our residents?
it's a multi-agency rule, and there have been repeated attempts to get 5 or 6 or 7, however many it is, agencies to agree. That's one thing.
On disclosures?
No, this is on, it's on policies to.
Yeah, which include disclosures and arrangements regarding executive pay and the risk of it.
There. Anyway, 956 is, you're right, we haven't been able to get agreement among the agencies. But more to the point, you know, there boards long since, this is just for the big banks where we have this authority, long since board of directors are very focused on how executive compensation works and that it not reward, you know, unnecessarily risky behavior and that kinds of things.
Yeah, but in Dodd-Frank, which Congress passed, there should, you know, you're supposed to put something in place. And it's not in place. And look, I'm saying this because so many people in this chamber, and I feel like the feds are more obsessed with wages than they are in regards to the monopolies, the corporate profiteering. There hasn't been any, I mean, really, I don't think there is a laser focus on that. And it's really, you know, because I think the feds and Congress can support fair wages and still combat inflation if you are fair in combating egregious executive pay, monopolies, and corporate profiteering.
We don't do competition policy, and we also don't, broadly speaking, regulate corporate wages.
But 956 would have addressed it. 956 addresses it. You should have it's 12 years.
The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Mr. Powell. Appreciate you coming in. I don't have to tell you the fact that housing, so goes the economy. I'm from a state that, from South Carolina, we have people moving in, the population's increasing. And I can tell you housing, not just single-family housing, is in trouble. People are finishing what's in the pipeline. It's now affected multifamily apartments, the high rents that they did get with inflation. That's entirely caused, for the most part, by the policies of this administration with gas, buying it from other countries, with supply chain shortages. There's no reason to start a project when you can't get supplies. And that's what we're facing in the housing industry at all levels. So any increase in interest is just another dagger that's going to kill the housing industry, along with commercial projects that, again, the pipeline's filling up, but the pipeline, once it leaves, you're not going to have any. And I'm from a state that's with people moving in. One of the things that you hear, I think Mr. Davidson mentioned, was regulations. Banks are complaining about being overregulated and the costs associated with it. CRA, I know when Brainerd left, it's in a state of flux. Who's determining that, and when will you have some guidelines out?
That'll be done by the whole Board of Governors when we vote on it, and also by the OCC and the FDIC.
Will they have any input from those who are having to pay the price of implementing CRA? Like, get any input from banks that are having to navigate?
So I know that throughout the multi-year process, there's been a tremendous amount of interaction with banks, tremendous amount, and bank lobby groups and also consumer groups. And then But yeah, there's been a ton of input and, working with the industry to try to achieve these statutory goals efficiently. I won't say it's perfect, but there's certainly been a lot of interaction.
So they're getting input prior to implementing the requirements for CRA, or the guidelines for CRA?
Yes, I think I'm I'm pretty sure there's been quite a bit of interaction with the industry in terms of what to do and how to do it.
Okay. Now, I think you've stated that you don't feel it's the Federal Reserve's policy to get into implementing climate change.
We're not, and we shouldn't be climate policymakers. We do have a small role, focused role to play, principally with the larger banks, to make sure they understand and can manage their climate risks in the long run.
Should it be mandated?
Should what be mandated?
Climate change policies be mandated by the Federal Reserve?
I think, again, climate change is something that's going to affect businesses and people and regions and states and whole countries, and I think that's got to be a job for elected people by and large. I think what we're going to affect is we just want to make sure that banks understand and can manage the risks that they're running, and these are principally longer-term risks.
What's concerning to those of us in the business community who have to borrow for banks, the Federal Reserve is conducting a pilot climate scenario analysis that's being mandated, not asked, it's being mandated for the six largest banks to participate in. That seems to me like a pretty good, when you have to do a scenario and mandate that they do this, is that not the Federal Reserve getting directly involved in mandating?
I think the banks actually want this. They want these six big banks, they have to face this globally, and what they want is uniform approaches and guidance on how to have one set of rules. They're already running, the big six banks that we're talking to, they're already running climate scenarios all the time, multiple climate scenarios.
Most of the banks are well capitalized now. That could change. And this is just another expense that is out there. On the CFPB, the history, I think you said it was 12%. It cannot go above 12% ratio. Has that, that does not seem logical to me. Has it ever been below the 12% from your perspective?
That's, someone here quoted the law, and that rang a bell for me. So that is what the law says. Have they been below? I'd have to go back. I'm happy to provide. It's all
if you could, because it
Happy to
seems to me like that's if you've got that cap, businesses couldn't operate like that because it would be no incentive to reduce the price as long as it's automated.
That's the way the law is set up.
Right. Thank you for being here.
Thank you.
The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being with us today. The end is in sight. I would like to begin by highlighting an issue that has been a concern for the Congressional Hispanic Caucus and others. I know that the chairman has suggested that we're going to weave in the diversity and inclusion issues throughout our hearings, so here goes my concern. There has never been a Latino Federal Reserve president. And further, only about 5% of the Federal Reserve's overall workforce identifies as Hispanic or Latino. As we know, over the past year or so, there have been several presidential vacancies at the Federal Reserve banks, and there has still been consistent failure to appoint a Latino candidate. Chair Powell, are you aware of this trend, and do you agree that it's a problem that our diversity and inclusion numbers are in the Federal Reserve Board are not reflective of the Latino population?
Yes, it's something we've been focusing on.
All right, and can we get a commitment from you that you'll work on the workforce issues internally?
Yes.
Well, thank you so much. And I'd like to now follow up a little bit on some of the questions from Representative Norman, because I too have a concern about housing costs, particularly as it relates to equity and the negative impact on minority communities. I think you said in your paper that activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. As he mentioned, the rates are higher, not only impacting single-family housing, but multifamily housing, and it's also becoming even more and more difficult for people in my district, which is 77% Latino, to be able to buy their first first-time, first home buyer, the workforce, entry-level kind of housing. As financing homes get harder, as mortgage to find and mortgage rates rise, the population of home buyers is skewing towards older, wealthier, and whiter communities. In many cases, in our suburbs, equity firms are buying out the housing stock. Chair Powell, can you please speak about the relationship between Federal Reserve interest rate hikes and housing inequity, and what needs to change here?
Well, what needs to change is we need to get inflation under control so that interest rates can come back down. In the meantime, they're high because inflation is hurting all of your constituents, not just the housing sector, and all of everybody's constituents. And it's our job under the law to restore price stability and also to keep maximum employment.
Is there anything else that Congress can be doing in this respect?
That would be up to Congress, but there are lots of ways in which Congress can support people in various ways, but that's really in your hands.
Right. Now, I want to move on into the numbers that you mentioned again in your remarks at page 2. You mentioned that, of course, we all know there's been a record historic unemployment rate. Is down now to 3.4%, the lowest, I believe, in history, and thank you, Mr. President, for that. But you also mentioned that there's 1.9 job openings for each unemployed individual. I wondered if you could tell me how you define unemployed individual. What does the unemployed individual profile look like?
So that has a very specific meaning. It's someone who is not working but is actively seeking a job. So for example, if you take 6 months off and stop looking for a job, you're no longer unemployed. So that means there's a group of people who are kind of around the edges of the labor force who don't count as unemployed. And those people are marginally attached to the labor force, that kind of thing. But to be actually unemployed, you've got to be looking actively for work in the statistics.
Right, so it does not include people who are perhaps disabled and cannot find accommodations in the workplace to be able to get a job.
Unless they're looking for it. The test is whether you're actively looking, I think, in the last 4
Actively looking regardless of, age,
That's right.
whether or not they're...
It's not a value judgment, it's the way we assess unemployment. We look at the other groups too, but actual unemployment is...
How do you factor in the people that actually are on unemployment insurance?
Sorry?
How do you factor in the people who are on unemployment insurance?
Well, they're unemployed. They've got to be, by definition, we count them as unemployed or they wouldn't qualify under the state requirements.
All right. Well, I just want to make sure that we clearly understand that there's children, there's people that are older, people that are disabled, people that can't find daycare. There's so many other reasons why someone is unemployed.
Yes.
All right, thank you. I yield back.
Gentleman from Wisconsin, Mr. Stile, the Chair of the House Administration Committee, is recognized for 5 minutes.
Chairman Powell, thank you for being here with us today. Your testimony today has been insightful as we look to tackle inflation, the impact that it's having on families across the United States right now. I want to go back to a comment that was quoted to you as regards to a question from Senator Kennedy yesterday regarding the impact that fiscal policy is having as it relates to inflation. And the quote that was attributed to you was that it wasn't a big factor. As we look at kind of a whole host of policies here on Capitol Hill, from reckless spending that we saw in the previous Congress, a lack of what we just discussed, individuals who are outside the labor market, how do we get these folks back into the labor market, whether or not we have policies that are discouraging folks to come back into work, as we look at high energy costs and opportunity to drive energy prices lower by unleashing American energy. How do you factor in the fiscal policies, or how should policymakers factor in the fiscal policies and their impact that's also having on inflation? Not looking for your advice on the fiscal policies, because I know you want to stay out of that, but how should lawmakers be looking at the fiscal policy and its impact on inflation?
So let's take energy, for example. So remember, inflation is the change in prices. It's not the level, as you well know. So energy prices have been coming down, right? They're still high, but they've been coming down, and they're contributing negatively to headline inflation. So when I say it's not contributing to inflation, that's what I mean. In addition, if you look at aggregate spending, it peaked, and then it's been coming down. So the fiscal impulse is actually negative at this point. It's no longer most of the inflation that we now have, something like 2/3 of the contribution of inflation in core PCE inflation comes from the services sector. And that isn't really about fiscal policy. Fiscal policy was important at the very beginning, so was monetary policy, by the way, but now it's more about just inflation is out there, and you have to bring it down. The record is it doesn't come down by itself unless it's driven by, transitory factors. For example, in the goods sector, the supply chains have been getting better, and as that's happened, goods inflation has come way down, and sometimes it's negative now. I hope that's helpful.
Yeah, no, thank you. And so to take that one step further, we're waiting on the president's budget. It's over a month late, but we're anticipating receiving that in the near term. And as we look at interest payments on the debt and the cash flow implications that has, not asking for what you're going to do at the next board meeting for obvious reasons, but as you are in those deliberations to future board meetings and potential rate increases, how does the impact of interest on the debt factor into the calculus of you and your colleagues?
So we don't look at that. We're not, if we started to change our monetary policy because we were concerned about the level of debt payments and things like that, that's not something that the United States needs to do, and it's not something we do.
Why would it be something the United States doesn't need to do? Could you elaborate on that?
Yeah, we're going to do our job. Congress has given us the job: maximum employment, price stability, regulate the banks, manage the payment system to some extent. We'll do those jobs. We don't have to worry about the United States budget. That is not our job. And it isn't that the debt today is unsustainable. It's that the path is unsustainable. So we can service our debts. It's just that we're on an unsustainable path, meaning that the debt is growing faster than the economy. So we would never consider. We will never look. If a central bank has to avoid taking actions because it's concerned about the budget, that's called fiscal dominance, and that's a thing you don't see among advanced economies, and it would be something we think we're a long way from that.
Thanks for your feedback on that point. The CBO just released their report showing potential interest payments on the debt accelerating dramatically over the next decade, showing it would be 14% of our fiscal spend. To compare that, right, national defense would be 13, Social Security is also 14, so it's in that level. That's a policymaker issue, but your insights are helpful. I know I only have a few seconds left, and a handful of my colleagues have commented on the ongoing review of bank capital standards. I just want to echo those concerns about what the impact would be of a significant capital level increase. Could you just comment briefly about how you quantify the cost of higher capital and the supposed benefits, and how you balance out that risk and reward?
So it's always a balance, exactly as you say. We know that the capital increases that I supported back in 12, 13, 14, 15, 16, earlier in my time at the Fed, they made the banks stronger and they made them more resilient, and you really want that. You want a banking system that can stand up and keep doing its job in times of crisis. So, but the exact balance between that and the availability of capital and the cost of capital is always going to be a matter of judgment.
Thank you very much. I yield back.
The gentlewoman from Georgia, Ms. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. As the member of Congress representing Atlanta, the city with the highest racial wealth gap in the country, I'm focused on creating an economy of inclusion, an economy that works for everyone and brings the most marginalized into our economy. Americans and Atlantans flourish when the economy works for everyone. The Federal Reserve has a mandate of maximum employment that is measured by analyzing various data points of economic conditions. In 2020, the Federal Reserve updated its approach to fulfilling and measuring this mandate to include job growth that was broad-based and inclusive. Chairman Powell, do you agree that broad-based and inclusive growth means job growth that helps reduce racial, employment, unemployment, and wage disparities?
I think it means what it says. We don't target any particular. We can't really target a particular racial or ethnic group with that, but we like to think that our decisions are informed by an understanding of diverse groups across the economy.
Well, Chairman Powell, could you share examples of how the Fed is including broad-based and inclusive job growth in the maximum employment mandate?
Sure, I'd be glad to. So one thing we do is we always, it's always part of the data that we look at each meeting. We always talk about it. We always mention it. different unemployment rates and labor force participation rates and wage rates and things like that by racial, ethnic, gender groups and that kind of thing. That's always in the data that we look at and talk about. That's the first thing. So it informs our pursuit of maximum employment. We're trying to take a broader and more inclusive understanding of what that statutory goal means.
Thank you. 2 weeks ago, the Federal Trade Commission released data indicating that Georgians reported the most fraud and scam claims of any other state in 2022, amounting to millions of stolen money. The Federal Reserve's website has resources to help consumers protect themselves from scams where criminals leverage the Federal Reserve's name, including emails claiming potential victims are eligible for lottery winnings, robocalls threatening arrest in exchange for money, and other phishing communications. Chairman Powell, how does the Federal Reserve measure whether its counter-fraud communications are reaching the most vulnerable households and communities, especially those that might not be following the Federal Reserve press releases or your website, or have limited access to broadband?
So we do, when those kind of scams happen, particularly when they involve us, we go on social media to try to reach people and tell them that if they're contacted by someone pretending to be a Federal Reserve person, that's not. So we do that. We work with our Inspector General who works with law enforcement to make sure that law enforcement's involved. So we're aware of these scams. I think you're talking about the ones that involve people pretending to be a Federal Reserve person and get in touch with me and we'll send you some money. And so we do what we can to reach out to the public on that.
So is that after the fact, but what happens before so that the general public is aware that this is happening? For those people who are not on social media or tracking is there another way to get this information out to the general public?
We do what we can. We're not an institution that deals with the general public very much. We deal with banks, and of course our rate hikes and rate cuts, our monetary policy affects all Americans. But I think when something like that happens, it's a broad program. It's a bunch of people who are perpetuating a fraud on many, many people, and we try to get out there quickly and try to reach people, and again, also alert law enforcement.
Thank you, Chairman. And Chairman McHenry, I yield back the balance of my time.
That is very kind and gracious of you. The first of the day. We need to commend that for the record. With that, we'll recognize the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you very much, Chairman McHenry. Thank you, Chairman Powell, for being with us. Chairman, is the Fed's commitment regarding ESG not to force investment banks to renege on their fiduciary responsibilities?
We don't actually have policies in effect in that space. That's not an assignment that we have.
You saw some issuances by heads of some investment banks, not to mention any names, that felt that was the case.
That the Fed was asking them to, we don't.
SEC, Fed, you stated a couple of minutes ago that you feel that some sort of ESG, you stated that banks want it. And
I'm talking, no, that's different, completely different. It's regulated financial institutions that we regulate and supervise. They're subject to, particularly the big ones, are subject
to
the
Fed,
climate change.
You agree that the Fed
issues all over the country.
won't ask banks to renege on their fiduciary responsibilities. The Fed won't do that.
We don't regulate the investment banks. The SEC does.
Okay, so the answer is no.
What's the question again?
I'll move on. Earlier, some of my colleagues and Chairman McHenry questioned the holistic review of the capital bank holdings. This holistic review, which no one has seen, according to my sources, but there are published reports that it will call for more capital to be held by banks. I understand the deferral to Vice Chair Barr, but do you have any thing that you could add that would warrant a need for large banks' capital increase?
So there isn't a proposal to evaluate or talk about yet. Vice Chair Barr has indicated he was going to take a look. He said he thinks capital is strong, and the question really is it strong enough? And I know he's been working, and there'll be a process when he does arrive at conclusions. He has no authority to enact something himself. It has to go through the Board of Governors, also through the FDIC and the OCC.
Okay, this has nothing to do with the
Transparent
QT,
process.
I'm sorry, with the QT initiative, the tightening of the money supply? They're not related at all?
No. No, I would say not.
Are you comfortable with the QT reductions which have taken place?
Yes, the balance sheet is, we have the balance sheet moving down at a healthy clip, and it seems to be going pretty well.
Okay,
Very well.
so the Biden administration's fiscal and energy policy has caused trillions in deficit spending, as you well know, very, very excessive trillions. Meanwhile, energy costs for the average American have, from heating oils to gasoline, have increased by over 40%, and businesses, of course, in the last, just over the last 2 years. So high energy obviously affects the cost for manufacturing, wages, general cost of living in almost every aspect of society. Would not such fiscal and energy policy work of the Biden administration working hand in hand with initiatives such as QT and initiatives of the Fed be far more effective than the Fed fighting inflation on your own?
Well, I mean, we are the agency that has the responsibility to restore price stability, and we just have to do it. That's the task we've been given under the law. It's great if Congress helps. It's great if the administration helps, but we have to deliver it, and we will. That's our responsibility, which we fully accept.
We're not risking stagflation if the fiscal policy and monetary policy are working against each other?
Again, we don't comment on fiscal policy. That's for elected people, and we have a job, maximum employment and price stability. We use our tools. We try to stay in our lane, stick to our knitting.
It's just the fear of a number of people that we're going to have high interest rates and higher than 2% inflation if there's not that level of fiscal and monetary cooperation.
Again, fiscal policy does what it's going to do. We take that as exogenous. That's the fiscal policy will be what you and your colleagues do with, and that comes into the economy, and we see it, and we don't have a view. We don't try to comment on the decisions that you make, and we use our tools to restore price stability no matter what happens outside of our building.
Sure. Okay. Mr. Chairman, I'll yield back. Thank you.
Gentleman yields back. We now recognize the ranking member of the Oversight Subcommittee, Mr. Green of Texas, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Powell, for being with us today. I greatly appreciate your work, but I would like to take just a few moments to talk about how our legislative bodies have legitimized systemic racism. It's been done by having a Fed that has a responsibility to produce maximum employment, knowing that the 2-to-1 black-white wage gap exists traditionally, and also knowing that traditional actions and methodologies will not change that. But yet, we won't give you the authority to make recommendations or to take actions that would directly target that. It's not your fault. It's the legislative body's fault. We perpetuate systemic racism in your mandate of maximum employment. We also perpetuate it in lending because we know that invidious discrimination exists in lending. We know it exists. And there are laws that will prevent and punish persons who cheat banks. You will be prosecuted and you will be fined criminally if you cheat a bank. No such law exists if you cheat a customer. And we know that black people who are more qualified than whites will get less money when they get a loan and pay a higher interest rate. These are all things that are the case. They're true. So legislative bodies continue to legitimize systemic racism. And the bodies have become so bold now, so many of the members, they're so bold now as to say they're sick and tired of hearing about this. They don't want a discussion about racism and systemic discrimination. They believe that all is well as long as all is well in the white world. Good many, they won't say it that way, Mr. Powell, but that's the way their actions would lead one to conclude they have positioned themselves. Many of these people are my friends, people that I associate with, talk to regularly. But there comes a time when you just have to be truthful. Systemic racism can be eliminated. It can be dealt with. We know how to, but we don't have the will to do it. So I don't fault you. I don't fault you. Not one scintilla of blame would I cast your way. It's the legislative body. It's the people who sit on this committee who won't allow laws to be passed, making it a crime to deny a person a loan who is qualified to get that loan. People on this committee who will say they don't want to hear anymore and encourage persons who are professionals, experts, encourage them to push back against talk about invidious discrimination. Systemic racism emanates from the legislative body. And you, sir, are in a very awkward position because I genuinely believe that you'd like to do something about it, but you can't. It creates a sad state of affairs. I thank you for the time, Mr. Chairman, and I yield back.
Gentleman's time has expired and yields back. The gentleman from Wisconsin, Mr. Fitzgerald, is recognized for 5 minutes.
Chairman, thanks for being here today. Probably get right under the wire here. I just had one, and some of my colleagues have touched on this today again, that there's certainly, I think we're well aware, I'm well aware, that there's a dynamic back in the district and across this nation. There's a certain segment of adults, 25 to 35-year-olds, many of them dual income, no kids, and they are completely froze out of the housing market right now, either because the cost of a home at a new subdivision in any municipality is $500,000 or more. And as a result of that, it's not only by actions of the Fed, I think, on the interest rates, but certainly the other thing I wanted to bring up, because the balance sheet at the Fed has gone from $4 trillion to $9 trillion post-pandemic, could the Fed, by no longer buying mortgage-backed securities, in a smaller universe of the private sector buyers who demand a higher rate of return, right? Is there not another kind of built-in trigger there that mortgage rates are going to continue to go higher, unrelated to what the Fed does? Because I think the concern is that between the dynamics of no new subdivisions, 25 to 35-year-olds unable to get a loan, and then interest rates continuing to climb, all of these factors are just, we're gonna lose a generation of adults here that are never gonna get home ownership. They're never gonna benefit, you know, which we all know is the big wealth builder for any family. So I'm just, if there's anything I take away from what we heard today in the questions asked, I hope that that is something that the Fed is in tune to and is looking at closely.
One thing is that this challenge with supply nationally, and that's zoning, it's people, it's materials, and so the housing stock is constrained to some extent by just harder to find zoning anymore because things are so built up in so many places, and those are not things that we can control. In terms of our ownership of mortgage-backed securities, what happens with them is they mature, or they're repaid or prepaid, and they run off on their own. That's a passive sort of way to shrink the balance sheet. And of course, they don't run off very quickly when rates are this high because people are not refinancing their mortgages because they have much lower mortgage rates. So, you know, there's no evidence at this point that, you know, that the market's having a hard time absorbing, you know, the supply of mortgages because the supply of new mortgages is very low. It's probably right, it has to be right, that when we're no longer buying mortgages, and we're not buying mortgages now, and I hope we don't have to buy any more mortgage-backed, we don't buy individual, you know, we buy mortgage-backed securities. I hope we're not doing that anytime soon. We only do that in really severe situations. That they're, you know, the fixed income markets are gigantic, and there's a lot of buyers out there, and where there's a yield, there'll be buyers. And I think I expect that'll be the case. It might, not that it wouldn't have some upward pressure on rates for us not to be a buyer anymore, but, you know, we weren't a buyer for a very long time. We thought we'd never go back in after the global financial crisis, and we kind of had to after the pandemic financial crisis just to keep the markets working, and now we've stopped again.
Good. Thank you very much, Chair, and I yield back.
Gentleman yields back. Noteworthy. I want to thank, in particular, our members, Mr. Fitzgerald and Ms. Williams, for their additional minutes back to the Fed chair. In a rate environment like this, time is money, and that's much more valuable these days. I'd like to thank the chair for his testimony. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for his response. I ask you, Chair Powell, to please respond as promptly as you're able. And with that, the hearing is adjourned.
Thank you.